Welcome back for another one of our exciting CEO Roundtable series of interviews. And today I have a great one. I'm honored to be joined by S&P 500 constituent Eric Bolton, the CEO of formerly known as Mid-America Apartment Communities, but now to those known as MAA. MAA is currently a top 5 constituent of the Home Appreciation US REIT ETF House. And I am so excited to be sitting here in Memphis today visiting with you, Eric. Thank you so much.
Glad to be here.
Before we hop into it, I want to just take a couple of points from your second quarter earnings. Now, you guys did just announce that you're announcing third quarter earnings on what date?
Last week of October.
Last week of October.
Yeah.
So 4 weeks from today, give or take, company will be announcing third quarter earnings. So the numbers I'm sharing with you are from their second quarter release, as well as they published a fantastic investor presentation. I recommend you go and check it out from the Bank of America Global REIT Conference that was just a couple of weeks ago in New York City. So MAA has a great September investor presentation that is very in-depth. But from their second quarter numbers, their same-store operating growth, they reported year-over-year growth of 13.7% on revenues, 8.1% growth on expenses, leading to an NOI growth of 17.1%. They have average effective rental unit growth of 14.3%, where they were charging $1,529 per unit, and occupancy was around just under 96%. In addition, in their second quarter earnings, they raised their annual guidance. Core FFO guidance run rate $8.13 to $8.37 a share, raised from $7.92 to $8.24. Can't preview third quarter earnings, obviously, any guidance talk there, but more to come here in the next few weeks. So as we go into it, sit back and let's learn all things fun about the Sunbelt apartment REITs with Eric. Eric, thank you so much for joining me today. This is so exciting.
Glad to do it.
So for those that don't know about MAA, I always kick this off with tell me the who, what, where, when, why, how. I say for the investor that's, let's say, in the villages down in Florida, and we're thinking of those in Florida right now, but for those that are down in Florida or in Seattle, Washington, who may not be familiar with MAA and the overall, tell us about the story.
Okay, well, happy to do so. MAA has been a public apartment REIT for 28 years, focused on the Sunbelt markets over this entire time. And really, our strategy has been very consistent over that 28-year period. And it really starts with a belief that as a publicly traded REIT, we believe that the best way to drive value for shareholder capital over the long haul is to really focus our capital deployment, financing strategy, operating strategy, everything that we do, focus it towards a goal of trying to build the highest recurring cash flow to pay a steady growing dividend through all phases of the cycle. We think that over a long period of time, that's the best way that capital gets rewarded as in the structure of a REIT and a REIT balance sheet. And so with that sort of broad objective, we have long believed that the best way to achieve that performance is to focus our capital on the Sunbelt markets, where we believe that job growth, migration trends, population growth, and ultimately the driver of demand for housing is likely to be the best over a long period of time. Now, we also work very actively to diversify across the region. We have presence in most all the major markets across the region, but we're also a bit unique in that we also target a lot of our allocation to more of the robust secondary markets, places like Jacksonville, Florida, Greenville, South Carolina, Charleston, South Carolina, where a lot of the REITs don't go. And what we have found is that that level of diversification provides a more stable level of earnings performance over the course of a full economic cycle, and ultimately drives, we believe, outperformance over a long period of time. I will point out that we have compounded return to shareholders for 20 years at just right at 15% a year for 20 years, which is well ahead of the sector average, which is probably around 9% or so. So we think the strategy has proven to work, and we have long focused our capital allocation in this manner, and plan to continue with that focus that we have.
As I was looking at your deck, it was bringing back fond memories for me. I'm in Dallas. I live right down the street from Market Center, your Market Center property, and I'd love to talk about that because that's a home run for you guys, I think. But for those that don't know, you guys acquired a very long tenured REIT way back when, Post Properties.
Correct.
And so your biggest exposure, Atlanta, Dallas, some of these, big metropolitan locations that you talk about. Looking back, can you talk about the integration of the Post merger for those that may not remember, or for those that do remember, like how has that looked? When did that was now?
About 6 years ago.
6 years ago now.
Yeah.
So wow, time flies.
Yeah.
Holy cow.
Yes.
So let's look back, because 6 years ago, because I remember Post Addison Circle based in my backyard, everything down in Houston. Now with it under the MAA flag, how has that evolved over those several years?
Well, it's been a fantastic combination, and we're thrilled with how it's played out. And just as a reminder, 5 years prior to that, we also acquired a Colonial Property Trust.
No Clipper.
And so the Post acquisition was our second time through a pretty significant M&A event, but we really at the time believed that there were a couple of things that we were trying to do from a strategic perspective that we felt like would really be helped by merging with Post Properties. One was that we were looking to continue to diversify the rental product that we had, and Post had a heavier concentration of sort of more higher end urban oriented product than what we had currently at the time in the portfolio, and felt that would be a good add to the profile that we had with the existing asset base. Secondly, Post had a very strong balance sheet. We actually deleveraged the overall company to do that merger. Their leverage was lower than we were, so we actually strengthened the balance sheet as a consequence of doing that merger. And of course, that has sort of served as a catalyst, if you will, for us to continue to make great progress on our balance sheet that we can talk more about in a moment. But the other thing I'll point out that was very, very attractive to us and important, and is now proven to be a really good add, is that Post had a very strong history and team and competency in development. And that was a skill set in our tool chest for growth that we didn't possess at the time. And so we added that team to our team, and we are now pretty active with external growth through development. It is continuing to bring and add a lot of value, we think, for our shareholders. And so on balance, the performance that we've gotten over the last 6 years as a consequence of putting these companies together has frankly well exceeded anything we expected, both for us and for the Post shareholders. So I think it's been a real win.
As we built out our ETF, we built it off of two fundamental principles. Where are people relocating across the country, and which of the residential REIT segments benefit from that relocation? And as I tell you that, I think about, again, the September investor presentation that you guys published, where you had a great map of the United States that showed where people are relocating towards your properties. Can you maybe talk a little bit about I guess you'd call it the non-MAA revenue generators going into the revenue generating markets, and which of those markets that you've been seeing call it the underperformers, the market performers, and the outperformers in your outlook?
Well, I will start with, recognizing that the migration trends to a lot of these Sunbelt markets by both employers and then subsequently people looking for jobs and households, that those trends were there prior to the pandemic and prior to COVID in 2020. We certainly have seen some level of acceleration of that trend over the last couple of years. But I also believe that those trends are likely to continue moving in a very positive way towards the Sun Belt as these markets and these states and this region of the country continues to offer broadly a more affordable lifestyle, lower taxes, less regulatory challenges for businesses. It continues to attract a lot of employers. And so, we continue to see a lot of migration from the coastal markets, particularly California and the Northeast, New York, New Jersey, Chicago areas continue to move into a lot of our markets. We are seeing a lot of growth from people moving from outside the Sun Belt into the Sun Belt, particularly in markets like Austin and Dallas and Raleigh, North Carolina. Nashville's been a real growth market. A lot of migration to Phoenix as well. And we continue to see a lot of good-paying jobs, a lot of knowledge-based jobs coming into these markets that we think fuel not only a strong demand for housing broadly, but also continues to support our ability to capture steady rent growth through the last couple of years, and we think continues to position the company to capture outsized performance from an operating perspective in terms of rent growth over the coming years.
We talk about the San Franciscos, the LAs, the New Yorks during COVID and how people left those towns. But in that same presentation, you commented on Washington. And I have not noticed other people comment on Washington. Why are people leaving Washington? What was I missing there?
I think that a lot of it has to do with just also the impact of people starting to realize that that remote working is a viable approach to how people can accomplish the work that they need to accomplish for whoever they work for, and I think I can't point to anything specifically as it relates to the DC market as to why people.
I was referring to Washington State.
Washington State. Oh, okay. Well, I think that Washington State would be just battling some of the same issues that we see in some of the other West Coast markets in terms of just lack of affordability, and frankly, we're also seeing a lot of employers bringing some of those tech-based jobs, and in some cases, I think some of the aerospace industry employment sectors that have been previously based in the West Coast, particularly in the Washington area, have continued to migrate to Charleston, South Carolina. We've seen some in the Raleigh, and these Southeast markets just continue, I think, attract job growth, primarily as a consequence of employers bringing jobs to this region. So
it's basically where the puck is going. It's trying to be where the puck is going. That's great. Very insightful. So I cue this to my credit, Al Otero, our portfolio manager, who you know from many years ago. He says, Eric, you're the senior statesman of the residential REIT sector, along with our friends out of Houston, the Camden guys. What attributes contributed most to your longevity and success in the industry?
I think it really just gets back to what I was pointing to a moment ago about our strategy. I have really endeavored to keep our focus pretty straightforward and pretty simple, and based everything that we do on the premise that we are looking to find a way to compound earnings growth and cash flow growth every year in an effort to continue to fund a steady growing dividend. And in my 28 years here at MAA, thinking back over the years and thinking about a lot of companies, REITs that are no longer, around. A lot of, I think, some of the prior issues and challenges some of those companies had sort of became, sort of a lot of the issues derived out of getting too focused on the notion of seeking trophy real estate and trophy markets. I think that in the real estate industry, I think is, and I don't mean this to sound negative, but I think it's comprised of a lot of deal junkies sometimes. And you have people that are really I think in some cases, over enamored with the idea that I've got to own, the trophy real estate in, the 6 top markets in the country, and believing that's the right way to create value. And, what we've long believed is, we've got to offer a product and a service that appeals to the broadest segment of the rental market that we can cater to, and think about ways to introduce appeal to that product, diversification of that product, so that you can weather the cycles, and also importantly, having been focused in these Sunbelt markets for 28 years, we understand the worries that sometimes come about as a function of supply coming into a market. And for many, many years, there was this criticism of the Sunbelt markets that the barriers to new construction, barriers to new supply were really low relative to a lot of the coastal markets. And therefore, by definition, you are always more exposed to supply side pressure. And I get that, and I understand that, but I've never really worried about the supply side of the equation. What I really, really worry about is the demand side of the equation. And there are things that we can do to mitigate the pressures of supply from time to time through thoughtful diversification, through intensity of operations, through creating advantages as a function of scale. And ultimately, I think that focus that we've long had, that is a pretty simple strategy, pretty anchored in that principle of how we want to perform for shareholder capital on a public REIT balance sheet, has probably we've been through periods where it's interesting. You go back and you look, that it's probably changed a little bit, but you go back 5, 6, 7 years ago, something like 86% of the NOI from the 6 largest apartment REITs originated in just 10 cities in the U.S. And as you might imagine, it was overwhelmingly the big coastal markets is where most of the NOI was coming from. And of course, we were different in that regard. And so, trying to justify that difference has had its moments over the years as we've tried to explain why we chose not to go to New York or Boston or San Francisco or Los Angeles. But it really anchors back in that principle about what we're trying to do in terms of performance profile for shareholder capital. And I've just had a very strong conviction in that, and if you will, stuck to my knitting and focus on that. And I think it has continued to serve us well. And as I pointed out, I mean, if you look particularly over most any of the performance horizons you want to, 5, 10, 15, 20 year or plus 25 years, you're going to find us in the top tier and generally at the top of the list.
You keep hammering these same points. We've only been doing this for a few minutes, but it's like looking out for the shareholder, growing that dividend. You're resonating with these key buzzwords that all investors are looking for, especially in days of like today with volatile tapes. We've been dealing with this for the past, frankly, all of 2022. That preservation of capital. How do we boost this dividend? What can we do to increase revenues, cut expenses, grow NOI so that dividend keeps growing? I mean, it seems like that's business driver 101. Like that's most important priority for you every single day, it seems.
It is. And, we raised the dividend 15% in the second quarter of this year. And our payout ratio, which is the dividend we pay as a percent of our earnings, AFFO, is still well below the sector average. And so the dividend strength is there. And again, I think that's ultimately what it's all about as an apartment REIT. It's not about, trying to go to the low cap rate markets. It's not about trying to go to the trophy markets. It's not about getting over enamored with, trophy assets. And it's not about trying to concentrate everything you have on the high-end assets. It's about trying to build a portfolio of properties that is likely to appeal to the broadest segment of the rental market through the cycle, so that you have the ability to continue to grow and fund the dividend, which again is a big part of, I think, what drives returns to capital over a long period of time as a public REIT. And I think that, it doesn't need to get any more complicated than that. But you just have to think about how you deploy capital, how you operate those assets, how you manage the balance sheet to anchor back to that focus and that strategy.
I mean, we can cut off the interview right here since we've already hit the message and we're done. But I mean, again, that's you can't reinforce that enough.
Yeah,
I think that is so important.
It's everything.
So playing into that revenue expense cycle, we talk about technology. Technological innovation in the apartment business is the unsung hero right now. Can you maybe tell us what it's going to look like over the next 3 to 5 years that could help transform the business and profitability?
This is probably one of the most exciting focuses that we have right now, and gives me just enormous energy and excitement about really the next 5 to 10 years for our company. We are in the process of transforming really almost every aspect of how we conduct business on site. It starts with the leasing operation, how we're using and modifying technology in the web to attract prospective new clients, finding ways to be more responsive to their needs through the introduction of artificial intelligence and bots that we've introduced into our systems to be very responsive to questions that they have, and be sure that we're being very reactive to anything they want to ask about 24/7. And the ability to then, capture more of that leasing traffic, convert it to, lease application, and then in turn, and go through, in some cases, we're introducing virtual touring where someone can, sitting in New York City and makes a decision to move to Dallas, they can go through the entire leasing experience, a virtual tour of the property, a virtual tour of the unit, and never leave their apartment in New York, and ultimately sign the lease, pay the deposit, and just show up and move in. But we're also finding that in some cases, people actually do want to still go look at the unit that they're going to live in and move into. And so trying to find ways to then support their ability to do that whenever it's convenient for them, not when it's convenient for us and our leasing staff was open. So introducing a lot of mobile technology that allows them to gain access to the property, gain access to the amenity areas, gain access to.
Wait, I just need my phone to get into the gym?
Well, there's certain processes you have to go through with us from a security perspective. But yes, you can ultimately show up at a property at whatever time you want to, take a tour of the property, take a tour of the unit that you are interested in, and or maybe you've seen it, but you need to bring your wife back to look at it. And you can do that whenever it's convenient for the both of you. And then obviously if you want to actually have someone show you around, we're available to do that as well. But ultimately the leasing experience is going through a tremendous transformation as we're finding consumers really want to change and alter how they do business with us. And we have to be responsive to a wide range of how people want to look at apartments and how people want to shop. And what that is also allowing us to do, of course, is to get more efficient in how we staff that kind of operation. And to the extent that technology continues to become an increasingly important element of that, it has implications for staffing levels. And we think that over the next few years, we'll start to see some significant savings that come about as a consequence of that. We're also finding new technologies that we're introducing in smart home technology, where we have the capability on a remote basis, just like our residents do, where they can control access to the unit, unlock and lock the front door through the phone app. We can monitor temperature, thermostat settings, lighting. Leak detection is also something that's part of the smart home technology, which has some benefits from a repair and maintenance perspective. So there's a lot of things that the smart home technology is unleashing in the area of how we can further drive not only convenience for our residents, but I think value in living there, which we hope manifests itself in opportunities to hold on to residents longer and ultimately leads to we think better pricing or renewal pricing as well. So I think that the leasing function is continuing to change. We're also rolling out a lot of new things that we're doing with lighting technology, introducing a lot more efficiency in our irrigation system. So we're pretty excited that we're about 150 basis point higher operating margin today than we were 2 years ago. We'll probably catch another 100 basis point lift over the next 12 to 18 months. And beyond that, I'm certain there's more margin expansion to come. With an NOI of about $1.5 billion, a few basis points of margin equates to pretty significant shareholder value. So it's fascinating how technology continues to evolve and introduce some I think just tremendous opportunity for not only adding value for our residents, but also driving efficiencies in how we operate, which obviously then leads to great shareholder value gain as well.
Talk about the next extension of that, which would be, what I call like the unit renovation program. A lot of the apartment REITs all have their own bells and whistles when they do their unit renovations. Talk about the MAA program. Obviously, that's how you implement the smart home technology into the units. But what else are you guys doing when you do a unit renovation?
It ranges all the way from what we call a light upgrade, which may be new plumbing fixtures and new lighting fixtures, all the way to a more extensive renovate, which would involve new cabinetry in the kitchens. It may involve new countertops. one of the great benefits that we get from new supply coming into the market is more often than not, on average, when new supply comes into a particular submarkets that we're in, given that land costs and construction costs have gone up so much, almost definitionally, the new product coming into the marketplace is going to have to command rent levels that are pretty high. And it's very difficult in the environment we find ourselves in today with construction cost and labor cost and land costs being so high. It's really hard to have that pencil out to enable you to come in with a really affordable or low rent level. So as a consequence of that, overwhelmingly, the new rental product coming into markets is at a very high rent level. And on average, is 20 to 25% higher than the rents that we are getting. And it then creates a meaningful opportunity for us to come in, and we're in very close proximity to that brand new property. We can go into the unit, make it feel like a brand new unit inside, and still offer a rent that's well below what the new apartment property is seeking, and therefore offer the market a great value proposition. They get something that effectively feels like a brand new apartment for a lot less than they have to pay down the street to the new person coming in at the new property. And so the way we've always approached renovation is we go in and we identify what we think is a market opportunity to do what I just described in terms of renovation. And then we will elect, okay, what are the features of the unit that we think are holding back pricing, that we could modify, upgrade in some fashion, and the market would pay for that. And we test it, and we may just switch out the light fixtures and the plumbing, and that's all we need to do. We may find that there's enough opportunity here given the submarket that we're in, and we found this particularly to be true with the legacy post assets, where we could go in with a more extensive renovation and get into cabinetry and countertops. So it's a fun thing that we do because we go in and we experiment. And in some cases, give you it's kind of a funny example, but we do it. Sometimes the cabinetry is fine, the boxes are fine, but the knobs on the doors are just a little bit outdated. Sometimes we'll just replace and get new modern looking door knobs or door handles. And it makes a huge impact. Of course, it's not very expensive, but it just has an impact that positions the product to be that much more appealing. We adjust the rents accordingly, and then we track it. We have in our system, we track the rents that we're getting on a non-renovated unit versus a renovated unit, hold ourselves accountable for making sure that we're getting enough of a rent bump on the renovation capital that we spent in order to justify the investment. And then if it works, then we'll do another 10 units. And if it continues to work, then we'll do another 10 units. So we approach it in a very systematic, careful way, and creating returns on investment, returns on capital that are well above 20%. We've been doing that for 5 years or so, and it's one of the great benefits, frankly, as I said, of new supply coming to market. It creates this opportunity for us.
As I say, a little bit goes a long way, right?
Yeah, absolutely.